Do you want your money to grow safely without taking crazy risks? In this video, I'll show you a complete investment plan you can use to build wealth for many years. I'll explain how much cash to keep in your bank, what percentage to invest in stocks, bonds, real estate, and even safe assets like gold. And I'll give you specific examples of funds and ETFs you can actually buy today. Then, I'll show you how much money you could realistically have in just 10 years if you stick to this plan. Step 1. Your cash safety net. Before you invest a single dollar, you need an emergency fund. Keep at least 3 to 6 months of your living expenses in cash, either in your bank account or in a high-yield savings account. For example, if you spend $2,000 a month, keep at least $6,000 to $12,000 in cash. This money is not an investment, it's your safety net. Step 2. Investment allocation. Now, with the rest of your money, here's how to split it up for safe, long-term growth. Stocks, 60% of your portfolio. Stocks are the growth engine of your investments. Instead of picking risky individual companies, use index funds and ETFs that spread your money across hundreds of businesses. U.S. stocks should be 40% of your portfolio. Now, I will tell you some U.S. stocks that has proven to be very good for long-term investments. Number 1. Vanguard. Total Stock Market ETF. It gives broad exposure to the entire U.S. stock market, is low cost, and is diversified, making it a simple, long-term investment option. Number 2. S&P 500 ETF tracks the 500 largest U.S. companies, offering diversification, stability, and strong long-term growth in a single, low-cost investment. Number 3. Schwab U.S. Dividend Equity ETF focuses on high-quality, dividend-paying U.S. companies, offering income plus long-term growth at a low cost. That's the only U.S. stocks you need. International stocks should be 20% of your portfolio. Now you need some international stocks that's good for long-term investments. Number 1. Vanguard. Total. International Stock ETF gives broad exposure to global markets outside the U.S., offering diversification and growth potential at a low cost. Number 2. iShares International ETF provides broad exposure to non-U.S. stocks, helping investors achieve global diversification with low costs. Number 3. Vanguard Emerging Markets. ETF gives exposure to growing economies outside developed markets, offering higher growth potential and diversification at a low cost. That's the only international stocks you need. Now, bonds should be 25% of your portfolio. Bonds make your portfolio more stable and give you steady interest income. Examples for the bonds I think is the best. Number 1. Vanguard. Total Bond Market. ETF offers broad exposure to U.S. investment-grade bonds, providing income, stability, and diversification at a low cost. Number 2. iShares Aggregate Bond ETF provides broad exposure to U.S. investment-grade bonds, offering income, stability, and portfolio diversification at a low cost. Number 3. Vanguard Short-Term Treasury ETF invests in short-term U.S. Treasury bonds, offering safety, stability, and liquidity with minimal interest rate risk. That's the only bonds you need. Now, real estate should be 10% of your portfolio. Real estate protects against inflation and adds diversification. Examples for some good real estate funds. Number 1. Vanguard Real Estate ETF gives exposure to U.S. real estate investment trusts, providing income through dividends and diversification beyond stocks and bonds. Number 2. Schwab U.S. REIT ETF invests in U.S. real estate investment trusts, offering dividend income, diversification, and low-cost access to real estate. That's the only 2 real estate funds you need. Now, alternatives and safe assets should be 5% of your portfolio. Keep a small slice in alternative safe assets like gold or inflation-protected securities. These are the best in my opinion. Number 1, SPDR Gold ETF provides exposure to physical gold, offering a hedge against inflation, currency risk, and market volatility. Number 2, iShares Gold Trust. It tracks the price of physical gold, providing a low-cost, convenient hedge against inflation and market volatility. Number 3. iShares TIPS, Bond ETF. It invests in U.S. Treasury inflation. Protected securities, offering inflation-adjusted income and portfolio stability. That's the only safe assets you need. Step 3. Example portfolio. If you had $10,000 to invest after your emergency fund, here's one way to split it. Place $4,000 in the U.S. stocks, and place $2,000 in the international stocks, and place $2,500 in the bonds, and place $1,000 in the real estate funds. And last, place $500 in gold or TIPS. Step 4. How much could this grow? Let's run the numbers. Imagine you start with $10,000 and add $1,000 every month for the next 10 years. Here's what your money could grow into depending on how the market performs. Conservative case with a 5% annual growth, you would have about $171,000. And the expected case with a 7% annual growth, you would have about $191,000. And in the best case with a 10% annual growth, you would have about $226,000. Remember, you only invested $130,000 of your own money. The rest came from a safe compounding growth. That's the power of starting early and staying consistent. Step 5. Rebalancing once a year. Check if your portfolio is out of balance. For example, if stocks grew too much and now they are 70% of your portfolio instead of 60%, sell a little and move that money into bonds or real estate. This keeps your risk under control. Step 6. Key takeaways. Keep 3 to 6 months of expenses in cash. Invest the rest using a simple, diversified mix. You should then have 60% in stocks, 5% in bonds, 10% in real estate, and 5% in gold or TIPS. Rebalance once a year and let your money grow. Investing doesn't have to be complicated or risky. By sticking to safe, diversified funds, you can build wealth slowly and steadily without stress. If this helped you, make sure to like this video, subscribe for more investing tips, and drop a comment to share your investing strategy.